Good morning, this is Ken Long from Tortoise Capital Management, May 12th, 2012, with a review of the weekend trading plan. We have a market that's still in bullish normal, although we're going to see that it has some cracks in it. On an annual basis, it's at 54 out of 100 on weekly RSI 14, so right square in the middle of neutral. On a 10-day basis, it is oversold at 16 out of 100 on the 10-day NDX. The slope of the 50-day moving average has gone negative at minus 0.06%. That's coded red and bearish. We remember that when the slope of the 50-day moving average is negative, that on average tomorrow is negative. So we'll want to see that get better. Percent stretch above the 200-day moving average is at 6.77%. Still bullish, but now coded white bullish. And we're only about little under 5% away from going back into sideways territory. ADX has increased to 17.1. It was at 15 last week. It's neutral, but rising, and unfortunately favors the bears. ATR percentage remains about steady at 1.14%, right square in the middle of normal. So we've got a bull normal market, oversold on a short-term basis. That's generally going to be buy on dip territory. But because we have pulled back right to that 5% boundary of noise channel, it's poised on a knife edge here to go sharply in either direction. So a 5% move the next week in either direction would not be a surprise. And I believe it favors the short side right now. Blended monthly rebalancing continues to hold in the 26 ETF portfolio, the Qs, financials, and U.S. Real estate. In the 13s, it's the Qs, real estate, and large caps. Next reevaluation will be on or about 1 June. In ETF 2, the theoretical model exposure is at 10% because 9 out of the 10 large indexes are on cash when compared to their 4-month moving average. The model portfolio itself is at 80% exposed. The 10% trailing stops are still in place and protecting the holdings that we have. So any sales that might come from those getting hit stays in cash until the market gets better, and I think that's a very good posture to be in. And sorting now the 13 and the 26 ETFs by the strength column, which is that blended monthly momentum. You can see it's the top 3 now, real estate, technology, and TLT has moved off the bottom back up into the top 3 on the basis of selling and weakness. The global markets continue to lag the most, with Latin America in the red. You can remember as little as 2 months ago that Latin America and emerging markets were the stealth bull story. That seems to have been put on hold. I see quite a large number on cash. In the 26 ETF, it's real estate, technology, financials, bonds, large caps, the rest of the U.S., bonds. The Swiss franc has been moving back up. You'll notice that it's red on both quality because of the volatility and red on its aggregate score, the average score, but it's moved off the bottom back up into the high yellow. Brazil, emerging markets, gold, agriculture, emerging Europe, all of those solidly in the red. That's a market that is losing faith in the risk-on trade, and you're seeing a recovery in bonds right now. Looking at the market health check, first we'll take a look at, I've added the river here. That's the 30-day Bollinger Band, plus or minus 1 standard deviation. The dotted line is the 30-period simple moving average, 30-day moving average. You can see it rolling over. Vertical blue lines are 10, 20, and 30 days worth of look back. The purple horizontal line is the previous swing high at 142. The solid red lines represent key support levels that have held before. You can see we're hovering right around this 136. The solid black line in the center is the 30-period regression line. You can see it sloping downward. And the outer black lines are the channel formed by the maximum excursion from the regression line during the look-back period. And now it's that move to 142 that is the max excursion. Before it used to be this pullback to 136, but now it's the top side is the furthest excursion. So this week we found support here around 135. Now the red box, the 5% red box, represents a 5% pullback from the previous swing high, and that is considered to be market noise and normal, but we are hovering right on that. A 10% move, which is off the chart, would take this down to another $7 off that, so about 128. And you can see that would put us into sideways territory because the 200-day moving average is at right about 127. So we're about 6% away, 7% away from that. You can see right now price is below the Bollinger Band. It's outside of the river. The regression line pointing down. The 10 period has crossed over the 50. The 50 has rolled over and gone flat, and as we saw, actually just went negative, and that's not a good thing. So we have a market that has failed to retest or to recover 142 and go beyond. It's actually starting to stall and roll over, and notice that turn in the river is sort of an ominous portent, and the fact that price is less than the 10 is less than the 50. 50 has gone negative. Bollinger Band has rolled over. Regression line slope pointing down. All of that is not so good. You can see that ADX has bottomed out. We're starting to get some trending behavior here, and the bears are in charge. So that's not good. We'll scroll down just a little bit. Williams percent R10 is oversold, has been oversold for a while. Again, that's a buy on dip opportunity in the bulls, but in bull markets, but this bull is decaying. So there's still room for it to go. It could, just staying within the channel, it could get up to 140. So there still is a favorable inside the channel bull bounce move here. For me, it would require entry above 137 with a target of about 141, the top of the channel here. And whether that's the regression channel or the Bollinger Band River, the far side, that's feasible too. But you'd have to have a pretty tight stop down here in order to see that as a 2-to-1. Percent price oscillator, the jaws are open to the downside and getting wider. That's an intermediate term negative. You can see that those conditions can last for as long as 30 days, and we're only about 5 days into that. The last time that it went negative, it was up here around 142, and by the time it closed, it was down here at 137. So that was kind of a noise channel move, and that to me is the same kind of move here that could be, if you could be setting up, and that would be from 139 to about 132, which really follows the regression line channel. So that would be a fully normal kind of a move. I replaced the slope indicator with this third one just to see how that looks for a while. The Bollinger Band width, that's $3.50 is how wide the river is. From the top to the bottom of the Bollinger Band is $3.50. You can see that for a while it was very quiet and narrow. In this little period here, you can see how the river is measurably narrower than it is here, but the river is turning and the Bollinger Band's getting wider, and that opens up the potential for moves to the downside. So market poised on a knife edge here, can go 5% in either direction with without stretching the bounds of credibility. ETF2 regional report. 9 out of the 10 are on a cash signal based on their moving average filter. So the theoretical models at 10% invested, 90% cash. Last week it was 40-60. SPY still remains stronger than the globals. Inside the U.S., it's still tech, large, medium, and smalls. Tech and large still the best. Japan and Latin America are the two weakest. You can see ILF is the absolute weakest at 36 on the red in strength and only 51 on average. World market model. Even the technology has moved back into above average. So all the U.S. is still above average. The winners in Asia remain the winners, Malaysia and Singapore. China and India continue to be laggards. Those are interesting short candidates. You could look at FXP for China. INP for India. Japan, Asia less, Japan below average. Latin America, emerging markets, all the rest of the Western Hemisphere well below average. Only U.S. real estate is in the green off the primaries. You can see the strength now in treasuries and corporate bonds, weakness in gold and silver, which still surprises me, but I'm ready to trade that in either direction. It's going to be volatile moves. Spain and France lagging. The defensive plays have now started to pick up inside the U.S., so we're seeing the risk-off trade starting to manifest here. Consumer staples, utilities, healthcare, and discretion still strong, and now materials, energy, finance, and industrials. You can see how far off the mark U.S. finance has occurred. I expect more of that to happen based on the J.P. Morgan loss of $2 billion through sloppiness and stupidity. What an amazing statement for them to be able to make. They are so horrible managing risk and money that they're just about qualified to be members of the U.S. government. Thank you very much. Tip your waitresses. So that looks like the risk-off trade manifesting with the XLPs of the world. That's consumer staples. That's still going to look pretty good to me. Top 30 of the ETFs from the ETF database. Home construction, biotech, U.S. real estate, retail, real estate, consumer discretionary, consumer staples select. The XLP, I think, is really the last bastion of the U.S. large cap equity story. When that one breaks, then it's really risk off and watch out to the downside. We're getting close to that. Among the Dow 30, the winners are still the winners. Home Depot, American Express, AT&T, Coke, Disney, Pfizer, Travelers. Those are your XLPs of the world. Walmart is even moving off the bottom now. McDonald's, I think, is an interesting story. That should do well relative to the tech and financials. If they start seeing weakness, I would see McDonald's to be at a moment of opportunity. So we're stalking that one. ETF liquidity. The VIX is down to 4.84% ATR percentage. So half the volatility has come out of the VIX, but I expect that to be on the move up. You can see a slight increase over here in volatility. Still very quiet on a long-term basis, but the most recent trend you can see by the slope of the 10-period moving average is up. All right, we're going to take a look now at. We'll go to the daily. The gap stat has been favoring the gap down in reverse 13 times out of the 19 times it's gapped down, 13 times it has reversed to close higher, and those have been follow-throughs of 0.41. But the gap down, and that continues to fail, so in other words, when it makes new lows, that has been the big follow-through day at 0.71%. So the percentage play is to bet on the rebound when you see it, but to reinforce failure when it occurs. That's how I read that. Overreaction system signals spiders, diamonds, and Asia less Japan. Channeling in spiders, tech, small caps, and Asia less Japan. All of those are reflective of that. It's still bullish, and it has pulled back in its channel and had system shock because of the J.P. Morgan news. But again, I would keep my risk measured on that one, and I would play it more short-term trend intraday or a day at a time, simply because of the fact that we've pulled back so far that ADX is favoring the bearishness, and ADX indicates lack of trending behavior. So to me, that says when you have them, make sure you get paid. You can see the time series of 10-day NDX here. Remains oversold, and it can stay that way for a long time, as we know. See, volatility has climbed up into the midpoint of normal of the last 180 days. ADX starting to roll up. A ton of channeling and overreaction systems. Choose your favorites. Silver in a 5-day down. Some 551Ws in 3M, Kraft, American Express, and Intel. A ton of things shape up on the auto framer, as you would expect whenever we're in a pullback condition like this. That makes the 10-day high a very reasonable target and a measurable target. 10-day losers: Cisco, Caterpillar, Alcoa, Bank of America, JP Morgan. Winners: Coke, Travelers, Walmart, Verizon, and AT&T. Coca-Cola, to me, looks very, very interesting. Coke and McDonald's, hamburger and a Coke is, I think, the order of the day. Tactical summary, you can see just how many frame out on the auto framer. Quite a large number of dojis, channeling and overreaction signals, and the 551Ws that we've looked at. See, JP Morgan just got crushed, down 10% on Friday. Same thing in the ETF 30, a large number of dojis, lots of auto framer candidates, and channeling and overreaction, some 5-day downs, silver and coal. Lots of high quality froggishness out there, so take your pick and go with your favorites. Regression line slope is down, R squared at 0.2%. Just says this is becoming a choppier market. You can see the regression line slope is below the 0 line and below average. The percent stretch is cracked, is now under 1 standard deviation above the 180-day average. You can see on the longer term time series, regression line slope rolled over. Could very easily get down here as low as it was. In the last 180 days, it's been very negative as well. And so that would lead us back to that 126, 127. That's what it would take. That's the price that we'd see if the regression line slope got measurably weaker. Just for reference, the frog numbers. VIX, Alcoa, Bank of America, JP Morgan have been the reliable ones. I love the fact that JP Morgan is still high on in the frog quality number here. That allows you to trade those intraday moves in that pretty effectively. Fail stats, signal to noise ratio, I'm not going to read it. 5-day holding periods, you see the Z-scores are all around 0.5-ish, except for Europe got hit pretty hard over the last 5 days, being down 2.83%. The 10-day scores are all just on the boundary of the maximum normal here at right around 1.0. You can see that mid caps have suffered the least on a Z-score basis, and we have just started a reasonable reversal move here in terms of 20-day and 40-day returns. So that says that another 6 to 8% is not out of the bounds of normal by any means. So this aging bull could be stumbling and falling here shortly and still be normal. Looking at the alpha stat, you can see all of the U.S. indexes have rolled over compared to the U.S. Even the Dow is back to normal. However, the Dow is starting to pick up, and that would favor that large cap XLP kind of trade. The 30-day scores in the commodities still weak. That tells me that they're in a position ready to bounce, and all of Europe and emerging markets have failed. Just more reference data. I want to take a look at some ideas that came out of the trading room earlier this week. The main one is this: we're applying the regression line crossover to. Let's see if we can get that on the screen here. Yeah, the regression line crossover to a 30-day chart. Let me get dogs. And I'd say basically this should not fill you with confidence. Dogs, hush. Well, the puppies want to go outside. That's okay. All right, there we go. So again, the river is the 30-period Bollinger Band plus or minus 1 standard deviation. The black line is the 30-period regression. Blue line is a 10-period regression. These horizontal dashes represent the VWAP, the volume weighted average price of that day based on the close. And the midpoint of the Bollinger Band, that red line is essentially a 30-period simple moving average, the longest term trend I would say I look at. The orange line, connects all the VWAP dots. That's a 2-period exponential moving average. You can see that acts as a proxy for price. You notice how it gets choppy in here when the VWAP started getting very choppy. I've highlighted this section here, this elbow in the river in yellow, coincides with when the river gets sideways based on the slope of that 30-period moving average. This was the end of that long bullish move up that we've enjoyed the first 4 months of this year. And then it got sideways right in here. I want you to notice that it gets sideways when the 30-period regression line comes back to the river. For this entire bull run, the 30-period regression line stayed out of the river. We first got a warning of weakness here when the 10-period regression in price went back into the river. But when the 10-period went back in, warning, it caused a little bit of a blip in the 30-period, but it smoothed out and kept going. And then the 10-period regression goes back into the river, followed shortly thereafter by the 30-period regression. When they go into the river, that signifies the end of a move. Here's the 30-period and 10-period regression line crossover outside of the river. That's an early warning. So when that happens, and then when the blue goes into the river is when I like to think about getting short, with the idea of a target of either the mean or the far side of the river, which is what we saw. And now we have this period of about almost 3 trading weeks of sideways. The river gets a little bit wider here. And then when the blue leaves the river, that's a warning to the other side. You see the Bollinger Band slope going down. And now all it takes to confirm this downward move is for the 30-period regression to leave the river. And it only is going to take another day or two of weakness, and that'll happen sort of confirm trending behavior to the downside. So in my view, this should not fill you with confidence on the upside. You get entered the river, leaving the river, going from up to sideways to beginnings of down, failure to retest 142. It only got to 141 and rolled over. So the downside is becoming more and more feasible here on the great big teeter-totter of price. The downside move is just beginning. So that's how I look at the regression line. And that's everything I want to say there. That's we're well into the morning, and we got a soccer tournament this weekend. So I'm going to hang this on YouTube for you, and I will not do a seminar or a webinar tonight because we get back from the tournament late. So Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.